like it. And for any guys here that are interested in crypto, well, we have Glen Goodman coming up, and he will, well, he's been trading stocks and shares, but over the last few years, he's been made famous for trading cryptos. So that's the guy you want to ask questions about when it comes down to the crypto markets. I think we can see you now, Glenn.
Great. Can you hear me as well?
Yes, we see your screen and your webcam.
Excellent. So you are just seeing a large me, are you, at the moment?
Plus your complete your desktop.
Okay, good. So if I want you to see this chart. Can you see this chart now or not?
Yes.
Okay. So what, just describe to me, Alex, before I start introducing myself, what can you see on the screen? Can you see me in a little window and the chart as well, or can you only see one or the other?
I can see both. Yeah.
Good. Well, then we are all right. Obviously, feel free to let me know if it doesn't quite look right. So, okay, so hello to everybody. I'm Glen Goodman. Some of you may have met me at various conferences or talks that I've given. You may have met me online through my Facebook page, Glen Goodman, the Shares Guy, or through my website, or you may have read my book, The Crypto Trader. Which has currently got a 40% off Black Friday deal. I'll give that to you at the end. This isn't a sales pitch, just like Charlie. This isn't about selling, so I'm only going to mention the book briefly at the end because of the 40% thing. So anyway, let's get straight on to what you came here for, which is to find out how the crypto markets are faring, how to trade them successfully, how I've been trading them successfully for many years now, and I'll talk you through it all. And if you caught the end of Charlie's talk there, you'll have heard him saying, oh, I'm not too sure about those crypto markets. I don't really do those crypto markets. They're not very liquid and that kind of thing. That used to be the case some years ago, even a few years ago. But since about 2016, when the Bitcoin boom sort of really started gathering pace, so many people came into the market that the top trading exchanges became really quite liquid. In other words, lots of buyers and sellers. That's what liquid means. And that's what you need in a market, because if you've ever traded something like, say, penny stocks, you'll have noticed that the very small penny stocks have huge spreads between the buy and sell price. So you'll kind of sell, you'll have to buy at quite a high price. And if you wanted to then sell again immediately, you would have to sell at a much lower price and you'd instantly make a big loss. That's the problem with any instrument that is illiquid, that's not liquid. Whereas by contrast, if you wanted to trade Amazon, say, you could buy a ton of Amazon shares and then sell them immediately at a price only slightly below the price that you bought them at. So you'd only make a tiny loss if you sold immediately. And that's why liquidity is so important, because it brings the buyers and sellers together and creates a nice tight spread, as we call it, between the bid and the offer price, or the buy and the sell price. So as I say, crypto markets have become a lot more liquid in recent years, and that's a very good thing. And it's allowed me to trade not just long term, not just investing in Bitcoin and holding on, hodling as they call it, holding on for dear life and just hoping it carries on going up forever. No, I was able to trade like a proper trader, which means buying and selling at specific points according to a strategy. Now, like Charlie was saying, like many, in fact, like most professional traders, I use trend following strategies of various kinds. Now, everybody differs slightly. You'll have heard Charlie just now talking about the MACD and this and that. You know, there are various different ways of defining a trend and deciding where the trend begins and then how long it goes up, and then you have to decide when it's ending, because you don't want to sell just because there's a temporary little fall, because those happen all the time. You want to sell at the end of a trend or near the end of a trend, and you want to buy near the beginning of a trend. Now, there are ways to define this, and there are ways to do it in a kind of semi-scientific way. Technical analysis, which is a field that's been developed for hundreds of years, but has really kind of become very mainstream in the past sort of 50 or so years. That is there are lots of tools there for defining trends. Now, funnily enough, even though technical analysis has come on in many ways in recent years and changed a lot, I think the old ways actually still work the best. And in fact, lots of academic studies that I cite in my book tell you that indeed the old ways are generally the tried and tested ways. They're the ones that work, whereas a lot of the newer kind of methods and indicators and ideas that have come along don't really add much to the mix. So if you kind of stick to your knitting, as we say in England, if you kind of stay with the essentials, then you have a great chance of doing really well. Let's get onto this chart now, because I want to show you, this is Bitcoin, and as you can see, it goes way, way back. I want to show you some of the key buying and selling points that Bitcoin has had over the years, right? Let's look at, let's use this one here. Right, we'll go all the way back to 2015. Right, here we are. Now this was the first big breakout on the way to the Bitcoin boom. You can see that the price was only about $320 back then, whereas now it's about, well, more than 20 times that price. So there was lots of money to be made. Initially, I will show you the concept, if you don't already know it, of support and resistance. This was what we call a resistance level, right? If you're not familiar with that, what it means is that the chart, this is sort of basic technical analysis here, the chart, every time the price reached this point, going back some way, it would bounce off it. And the reason is because partly it becomes a self-fulfilling prophecy with support and resistance levels. This is what you call a resistance level, because every time the price tries to get to it, there is resistance and it bounces back downwards. Likewise, you can draw a support line around about here. Every time the price got to that support, it would try to go downwards, but then a load of buyers would come in and buy again. And you would end up with this trading range going sideways between the support and the resistance levels, the price going up and down and up and down and up and down for, in this case, about a year or more. And as you can see, there was a brief period where the price tried to break downwards, but failed. Very quickly, it came back up. That was a failed break of support. And then you were back within this trading range. And then you see this lovely parabolic build up here, which is always a good sign when you see a nice parabola like that, if you remember from your maths when you're a kid. The parabola builds up and it shows that strength is building, and then the price bursts through. It bursts through the resistance level. When you get a big burst like that, it's usually not any kind of coincidence. It really does mean that something significant has changed in the market, in the psychology of the market. And this is the important thing. We're not just drawing random lines on a chart here. What these lines do is they define for us the psychology. All the buyers and sellers, all their different mindsets, all going on together, form this channel here, and they help to form the resistance and the support lines. Because what happens is every time the price gets to a certain level, then people start thinking that they're going to sell for particular reasons. And there are so many different mindsets, but I'll give you an example of just one mindset, right? If people previously saw a support level, a resistance level, and they bought at that level, and then the price started going down again, then when they get scared because they've made a loss. And when the price then rises back up to that same resistance level a little later on, they're very relieved. And those people who bought and then were hanging on with a loss, just praying that the price came back up, when it gets back up to the point that they bought it at, they sell. And that automatically pushes the price down. Now, you only need a relatively small number of people doing things like that before other people start noticing that the price always falls at that level, a level that a lot of people have previously bought at. And so soon, once people notice this, they then draw little lines like me. And before you know it, it's a self-fulfilling prophecy. Because everybody expects the price to fall at that resistance level, then they all start selling at that level. So it kind of reinforces itself for a certain amount of time until eventually you get a critical mass, a kind of point where the buying is so strong that the price just shoots up. And in this case, it almost doubled I mean, that was an astonishing rise in just the space of a few days, from sort of 300 to more than 500. That was huge and was a proper breakout. But what you often get then, and this is really annoying in trading, it's one of the most annoying things about trading, but it's just a normal cost of trading, is that the price then shoots all the way back down again to do what we call a retest of the original breakout level, as it retests it before then taking off again. Now, the problem is that there's nothing destined about any of this. Prices often break out and then they often retest, but they don't necessarily then take off again. It doesn't always happen, unfortunately, which is very annoying. And so this is why there are two cardinal maxims in trading that pretty much every major trader follows, and they are run your profits and cut your losses. Cut your losses is the #1 rule in trading. And what that means is if you're making a loss, anything more than a very small loss, you get out of that trade, because it only takes a few big losses to absolutely murder your account, to kill it, to lose all your money. In the case of most people, that's what tends to happen, which is why so many traders, the vast majority of traders, end up losing money trading. And that is a statistical fact. You can see it in the ads for any of the brokers. They all say 75% or 80% of people with accounts lose money in their accounts, and in a lot of those cases they will lose all their money in those accounts. And the main reason is because they don't follow that one simple rule: cut your losses. Because if you always get out of a trade when you only have a small loss, then you can take a lot of small losses, right? Whereas all you need is one big win when you're running your profits upwards, like this kind of big win up to here, and that basically cancels out so many small losses that you may have previously made. Whereas if you'd made a few big losses, it might not cancel it out. It's really important to cut your losses and only make at most a small loss on a trade, right? So let's have a look here at Bitcoin. Now, something I've started doing recently, and this is a little more controversial, but I'm going to tell you anyway, is, you know, I used to run sort of more high risk, I suppose, in my trading, because what I would do is if I had a big breakout like this, I would let the profits run. And that means that I would let the price come all the way back down to here before then taking off again. So I'd be making loads of profit and then losing it all and then making it all again. And as I'm getting older and I would like to kind of moderate my risk more, my risk level, I've started banking some of the profit. So on a trade like this, for example, what I would do now is I would buy it at this breakout level as it breaks through resistance. That's the point that I always choose to buy. And that's a very popular, again, with professional traders, it's a very popular place to buy, is just after a breakout point like that one, right? So say I'd buy there at about 320, and then I'd go, and the price would go all the way up to 500. Now, as it started getting really kind of crazy up here, what I tend to do these days is I close half of my position, which means I bank half of the profits, but then keep the rest of the position open. So say I traded based on, say I traded, you know, $1 a point. So that, you know, that, I mean, I tend to trade much larger than that, but say I was trading $1 a point, and so I had almost a $200 profit by the time it got up to 500. I would then close half the trade, so I'd bank $100 of that profit, and then I would keep the rest of the trade running. So then, as it fell back down, I would lose the rest of my profit, but I wouldn't feel so bad about it because I'd already banked half of the profit. So even if this curve just continued to fall and I had to close my position, because of course I always close if there's more than a small loss, then at least I'd be happy. Okay, I made a small loss on the second part of my position, but on the first part of my position, I made a decent profit, so I feel okay about that. But what would have actually happened is that the price would have taken off again, and so the second half of my position, the part that I kept open, would keep running, and it would keep running, and look at that, and look at that, and look at that. And that was the great Bitcoin boom, in which I had some of the happiest times of my life, I can tell you. What then we get to the Bitcoin crash. Now, this is the bit where a lot of people got really miserable. I wasn't miserable because I posted on my Facebook publicly for anybody to see a warning. And about this point here, I'd said, I don't like the way this is looking. We've had a lovely steep exponential rise in price, like an exponential curve, again, from your maths, from your schooling. And that curve had been broken. That was one of several signs that said to me, it's probably time to sell, but I'm not quite sure yet. So I waited a little bit. I waited until about here, and then I started selling because we'd failed to make a higher high. The price had gone up to here, gone down, and then gone up again, but hadn't breached the previous high. It hadn't got all the way up there. It started falling again, and that was kind of my sign, right, I'm going to sell. And I started selling a lot of my other cryptocurrencies as well, not just Bitcoin. And so I was able to keep my profits by basically, from my experience, I've been trading for 20 years, and I know when a trend looks like it's ending. As I say, there are lots of different signs, and I can't go into them all now, but I've just given you a couple there. The breaking of an exponential curve, because it just suddenly does something very different, and then also the failing to make a higher high on the next attempt is usually kind of my sign to sell. Now, let's get into more recent times, because the price fell. I was out of the market for most of this time. I made a few little attempts to get back in, like say around here, I think, but you know, they weren't successful. So I would get out with either small profits or small losses. Didn't really bother me, not significant for my bottom line. And then we get to about here, where loads of the crypto bros were all going, it's time for the next bull market. But I knew from just the look of the chart that was highly unlikely. I can draw for you actually the reason why I thought that was very unlikely. Here, that's the resistance line, and this, hold on, this is the support line. Right now, if you read my book, you'll get a lot more detail about the different patterns that you can see in charts and that kind of thing. Some of these patterns are quite relevant. As I say, they've been proven by many academic studies to have validity, that you can trade off like basically geometric patterns like a triangle that I've drawn here. This triangle is a downward sloping triangle with a base that is almost horizontal, but not quite, but it's horizontal enough. That is a bearish sign when you get a kind of triangle where you get a kind of slope downwards and then a kind of more or less horizontal base. That tends to be a very bearish sign. So I was expecting the chart to go down, and indeed it did. It plummeted down to what they call the Bitcoin winter or crypto winter at around about $3,200, where a lot of people started giving up. Now this is where things got really interesting and why I managed to make profit this year on various trades. Okay, I'll show you what happened here. So we have the crypto winter, a lot of traders deciding to give up at the beginning of 2019 because they lost so much money and they just had enough of it. They're sick to death of it. But this is what happened over the next few months. An upward sloping triangle was forming. Yes, rather like that downward one we just saw, but in reverse. Now, the reason why it forms in this way is because of what we were talking about before. A lot of people would have started buying at this point, and you can see that the volume was quite high. These are the volume bars at the bottom here. These blue bars or green bars were quite high at that point, as opposed to say here where they're quite low. And that means a lot of people were buying and selling at this point here. Now that's because a lot of people decided, the ones who hadn't left the market for good, had decided now's the time to get back in. Look, this is the beginning of the new uptrend. So they started buying, but they didn't realize that there were still a lot of sellers in the market who hadn't quite given up. So they started selling at that point. And that means that the people who bought here were getting very upset because the price was falling and falling, and they were losing tons of money, and they were getting very scared, and they were worried about what their wife or husband was going to say when they said we're losing most of our life savings because I was so sure the crypto market was recovering. So basically, when the price then starts rising again, they're so relieved that when it gets back up to here, they are just so relieved that they start selling at the point that they bought, right? Because they want to break even so that they can go back to their wife or husband and say, oh, don't worry, our life savings are safe after all. You don't have to leave me. You don't have to take the kids. It's fine. So a lot of buyers who suffer buyer's remorse because the price has gone down, when it starts going up again, they're so relieved they sell at the same point that they bought in order to break even, just so that they can get out flat without losses, right? And that, all that selling that they do pushes the price back down. And then you get your self-reinforcing resistance line that we talked about earlier. And you've also got your support line that is building there. Perhaps I should only draw it from there because you had a significant deviation there. But anyway, it's a triangle. It's going upwards. And because it's got a more or less horizontal resistance line and a sloping support line, what that tells you is that it's probably going to break out upwards. But the reason I always wait until a breakout is actually happening to buy is because you don't know for sure, because sometimes these things don't break out the way you expect. Sometimes they go the other way. This could have gone downwards, right? I mean, that happens a significant proportion of the time. Yes, most of the time the breakout will happen in the way that the chart suggests, but that's only most of the time, not all of the time. And so you don't want to end up nursing unnecessary losses, which is why it's always a good idea to wait until the breakout actually begins. So I did. I waited until the breakout had just begun. I bought, and whoosh, up goes the chart. That was a lovely, lovely breakout where some people, but not many people, made really good money. And I say not many people because, as I say, most people have given up. You know, it's the end of the bear market. Everybody's depressed. People aren't in a mood for buying. A lot of people weren't looking at the charts carefully. They weren't seeing this triangle, right? But anyway, so there you go. That was a huge rise of about 25% in one day. I mean, how often do you get that in stocks or indeed at anything else? A 25% rise in one day. So clearly it wasn't worth giving up on Bitcoin and deciding it was all dead. Now let's look at the next bit. This is where things started getting really interesting because loads of people started getting the old FOMO, fear of missing out, because they had missed out on that 25% profit there and they were thinking, oh, I don't want to miss the next one. So I was on various websites discussing with people what the new pattern was that was forming, and there was a lot of disagreement about what pattern was forming. I decided it was this kind of upward sloping flag, you would call it, though it is broadening slightly, which is unusual, but nonetheless, to me, this was an upward sloping flag. And because it was upward sloping, again, you'll see this is one of the most popular patterns. It's in my book. You'll see it all the time in markets. Once I point it out to you, you'll start noticing it everywhere. Upward sloping flags have a bias to the upside like this. So basically, it's a continuation pattern, we call it. So once it's started like that, you're more likely to get an upward breakout than a downward breakout. But once again, I always wait until the breakout actually happens before I enter my trade, because you can never be sure. What if it started falling, and that would be depressing and I'd make unnecessary losses? So I wait patiently for, in this case, what was it, more than a month. And a lot of people were saying on these discussion boards, that's not a flag, I don't think that works, no, I don't like the look of it, blah, blah, blah. You know, people see the same things in different ways, obviously. You know, now I've drawn these two lines on it, it looks to all of us like a flag, but it doesn't always, you know, patterns can be interpreted in different ways, and experience helps a lot. Obviously, the more of these things you look at, the more you get used to identifying particular patterns. But anyway, so then it broke out again, massive rise, and I bought and I made a big profit, and hooray. Now things get really complicated, and this is because the further along you get in a trend, the more people start entering, and the more they kind of mess up your nice patterns by employing all kinds of different trading techniques. It's because things are getting, you know, busier and more interesting. As you can see, the volume bars here are quite large. Things are getting interesting. Right, so what we had here is what we call a head and shoulders pattern. And this is a bearish pattern, right? Again, you can, sorry to keep referring to my book, but because this is quite a short webinar, I don't have time to go into massive amounts of detail about how all these patterns work. But this pattern that had formed here called head and shoulders. That's what you call the first shoulder, that's what you call the head, and that's what you call the second shoulder. So it looks vaguely like a human head and shoulders, right? You would normally expect that to break downwards. So I had drawn a line here and I was waiting for it to break downwards, but it didn't break downwards. And when it didn't break downwards, that was my cue to think, this could be a failed head and shoulders. And a failed head and shoulders can be just as tradable as a successful head and shoulders, right? So basically the failing of the head and shoulders happens about here when the price gets to just above the second shoulder. That means that it's failed to break downwards, and instead it seems to be going upwards beyond where we would expect. That was my cue to buy. So I bought about here, and then the price went up and up and up and up. Another big profit. It got all the way to $14,000, which is a more than quadrupling from the bottom of the market. So for anybody who says, the crypto market's been in a bear market ever since 2018, it's really depressing, what's the point in trading it? I mean, it's like it's quadrupled this year, and then it started going down again. So yeah, it's, you know, you've got to call that some kind of a bull market, surely. I know that we might still be within a larger bear market that began in 2018, because as you can see, the price has been falling ever since. So you might go, we're still in the bear market that began all the way back there in 2018. That's an interpretation. But nonetheless, as you can see, there were massive trading opportunities along the way, and I took advantage of them, more than quadrupling in price. Once it got to near the top here, I had a, not a revelation, a realization rather similar to the one that I did in the end of 2017, beginning of 2018. I could see that we'd had a steep upward parabolic or exponential curve, which was now broken. I didn't like the look of it. I got out. Didn't want to take any risks, particularly. I think I sold the last part of my trade around about here when we failed to make a higher high, just like at the beginning of 2018. We failed to make a higher high, started falling downwards again. Time to get out. Not looking great. I didn't want to risk it. I mean, there's always the possibility, because we never know the future. Remember that. Nobody ever knows the future. Any trader who tells you the price of Bitcoin is going up or the price of Bitcoin is going to go down, they don't know what they're talking about, because nobody knows the future. If they did know the future, they would be the richest person in the world. So only listen to the richest person in the world. So you can listen to Warren Buffett. I'll let you listen to him. But everybody else, or George Soros, everyone else is talking rubbish. Okay, those people are the only clairvoyants in the industry. Well, they're not. They're just very, very good strategists. But anyway, so as I say, it wasn't looking good. There was always a chance the price would go even higher at this point, but it didn't look good to me. The signs were not looking good. So I got out, and then I watched, and I sat on my hands. Very important to learn to sit on your hands a lot of the time when you're trading, not just trade for the sake of trading. And again, we got a downward sloping triangle forming here, which is a bearish pattern, as we said earlier. And indeed, the price started falling. And what it's done since then is make a few attempts to kind of get higher and higher again, but failing. So what we can say here is, actually, this is a good example of when a pattern morphs into another pattern. You quite often get this, where you've got a small pattern and it forms part eventually of a larger pattern. So in this case, the larger pattern is a downward sloping channel, right? I'll get rid of that original triangle because it will just confuse things. There you go. We have this kind of pattern here. In fact, some people draw it in I could probably draw it so that it looks more parallel than that. Which pleases people aesthetically, but probably doesn't really mean anything. But so it's kind of like a downward sloping flag, but a very, very long one. Or you could just call it a channel. I mean, they call these things all different names in textbooks, but you know what I'm talking about, right? Now, this pattern would normally have a bullish bias, which means that when it eventually ends, when we stop all this up, down, making lower highs and lower lows, which could go on for some time longer, really could. There's no reason why it shouldn't. Up, down, when it eventually ends, we would expect it to break out upwards, because that's what these kind of things tend to do. So it'd be really nice, for example, if this current one broke out upwards, because we're in a current little upswing here. Wouldn't it be nice if that happened? It may do, and it may not do. That's the problem. We don't know whether that'll happen or whether there'll be a rebound back down there, and then another up, and then another down, and then another up. So, I mean, I confess I'm doing a few little trades on these swings backwards and forwards. So I've made some money like here as it fell, and then I closed the trade. I made some money here as it rose, and or not in that one. No, I made some money on this recent one as it went up. Started going up again because I noticed that it was swinging. You know, once you see a pattern that it's swinging backwards and forwards, you can trade that. You can make money out of it as long as you buy and sell at approximately the right points. But as I say, I don't have much faith at the moment that this is just going to burst out upwards. So I may well close my trade before we even get to this line here. Once we see a bursting through this line, and we actually had one false start there, you can see, I think I broke about even on that trade because I bought as it broke out. You see that little spike there, and then it failed to follow through. It started falling back very strongly, so I sold. I either made a small profit or a small loss on that trade, but you know, either way, it's as some people say, it's like throwing poo at the wall and seeing what sticks. So I threw some poo at the wall there. I tried that trade, it failed. I got out with a small profit or a small loss. It's neither here nor there. You just got to try these things, and you know, sometimes you strike it lucky and you get a fantastic trade. So hopefully one day, where's that purple arrow gone? This will break out upwards in a big way, one would hope. As I say, nothing inevitable about it, but the chart implies that it's the most likely possibility. And if that happens, I will be buying above the dotted line, wherever that is. It might be down here, say. You know, we might be 6 months down the line and I'll be buying at that point there. Or it might be tomorrow and I'll be buying at that point there and making the profit. But either way, it's doable. It's make moneyable. I know I've had to go through a lot of stuff in a very short space of time. So if you're new to this, I don't know how much of it will have made perfect sense to you. Don't worry, there's a hell of a lot to take in there, clearly. As I say, I'll show you the link to get 40% off my book at the end, because my book goes through all this, but just at a nice plodding pace. Fun, but plodding, and you know, that way you can learn it at your own pace, because this stuff is crucial to learn. If you just trade without a plan like this, you will lose money, because that's what everybody does. Basically, it's what I used to do before I had a plan. In my early days of trading, I could tell you some stories, but I won't, because they're in my book, which I promised not to mention, but for some reason I keep mentioning. Anyway, Alex, at this point, are there any questions? There's more stuff I can cover, but if there are any questions at this point, I'm happy to answer them. Alex?
Yes, I can't see any questions right now. If anybody has them, please just put them in the chat box. But I had my own question.
Oh yeah.
I don't know if you covered this, but how do you deal with money management? Do you go all in, or how do you deal with that?
How do I deal with money management? That is a whole big topic that, again, I cover in my book that I'm not going to mention.
You just did.
In brief, I can give it to you in brief, which is 1% is the rule of thumb. Do you use that as well, Alex? Risking 1% on a trade?
Yes. However, though, when it comes down to crypto trading, what I did when I traded that quite a lot is that I just put a certain money on an exchange traded account that I was willing to lose, right? And
Right.
I was trading with no leverage really. So I would put positions on, like I would take maybe a third of my portfolio
Okay.
and buy a coin. And if the breakout went well, I would buy it for another third. And then I would take the other third and try to position somewhere else. But I must admit, because I set money aside and I was willing to lose everything, I think on average I was willing to give maybe 10% of that portfolio into a trade. And I didn't have stop loss orders at the same way as I have
Right.
on my margin trading. On my margin trading, I just stick to 1.5%. So difference between entry and stop loss should equal 1.5%.
Right. Yeah, it's but you don't do that anymore, is that what you're saying?
I do it on my. I'm not trading. I haven't been trading. So I had a crypto trading account with Kraken,
Right.
and what happened here is that in my case, I didn't mind going long cryptos, but I did not want to short sell cryptos because of the spikes that you see.
Right.
So, what happened here is that from the peak, as you know, in 2018 or 2000, was it December 2017, as the market just traded lower and lower and lower, and I was only looking to buy opportunities and I didn't really see any. I actually just went back to margin trading, and in 2018, I traded a lot of stock indices at the end.
Right, I see. Okay, well, this is how I manage the risk. I use, as a rule of thumb, you can say 1% of your trading capital should be risked on any one trade. That is a really good rule of thumb, which has been proven by a lot of statistical testing, to give you an amount of risk that probably won't ever bankrupt you, right? And I know that sounds quite scary saying that, but it's so important to say, because if you even risk, say, 2% of your account on any one trade, then sooner or later you will encounter a run of losses just by sheer bad luck, that could bankrupt you, that could get rid of your entire account. But certainly once you get up to 5% risk on each trade. And bear in mind, most beginners will happily risk 5% or 10% of their entire account on a trade. But once you get up to that 5% per trade level, you're pretty much certain that sooner or later you will lose all your money. And it's astonishing. And people who've been trading even for, say, a year or so will say to me, but I've been trading like risking 5% or more of my capital on trades. I've been doing it for a year and I haven't gone bankrupt. And it's like, yeah, you haven't this year, but give it, say, 5 years. That statistically speaking, you're almost certain at some point to encounter a series of events that will lose you everything if you're risking 5% on each trade, because you just will have a string of losses, a very big string of losses at some point. Everybody does. And the only way to stop that string is to stop trading altogether. It's just bad luck. Things go wrong in trading as in life. It's kind of like, playing poker and just being dealt a lot of bad hands in a row. It happens from time to time. So that's why the 1% rule is followed by so many professional traders, risking no more than 1% of their trading capital on an individual trade. And that's pretty much what I do. So what that effect,
I agree
oh, sorry.
100% on that. And later in my presentation, I've done some statistical analysis where I let the software do about 100,000 trades. And
Okay.
you can just see that statistically over time, as you say, if you put too much risk on, you will have that drawdown, which will kick you out of business. Now, what
Yes.
we're going to do now, I'm actually going to make you an organizer because there are a few questions here. And if I make you
Okay.
an organizer, you can actually see them.
Right. Questions. How do I see them?
There should be a section there in the middle, and then you need to maximize it, sort of. There's a question here from Laura.
Yeah, I can see the box, but for some reason it's not
So
appearing large enough. I've tried to maximize it, but it's
yeah,
yeah, it's not looking right on my screen. So you'll have to tell me what the questions are, I think.
okay, all right, let's do it like that then. So we got first a comment here by Karen Corbett saying that great presentation. Thanks, Glenn.
Oh, hi, Karen. I've spoken to Karen on via email a few times, I think, or not, or via Facebook.
All right. And then we have Laura asking, when you are trend following, could you not have short positions when the price were falling?
Let's have a look. When you I can actually see the questions now. So yeah, thanks, Karen. Thanks for thanking me for my presentation. Right, Laura, when you are trend following, could you not have short positions when the price were falling? Yes, you can, and I did, is the answer to that, Laura. I did have short positions lots of times, but I haven't got into that in this presentation because shorting is hard, and I was kind of aiming this at everybody, including beginners. Shorting is difficult to get right for a number of different reasons. One of the main reasons is that you often get massive bounces on a short. I will show you. Hold on a sec. Give you an example. Well, like here, at the end of 2018, for example, 2017, say you'd gone short at the top here, and you see it spikes all the way down there, and you'd be like, oh my God, I've done a short trade. I'm making so much money from the price going down, but then it bounces so far back up. And that is very, very typical. So it's really hard for beginners to work out when they should close that trade. You know, should they wait for the bounce all the way back up, or should they close it when it looks quite low, but then they might miss out on it falling even further? I mean, you have a similar process when prices are going up, but it's just even harder when prices are going down to get it right. I mean, a perfect short was this one here, and I think I made a bit of money out of that one. I think that was one where I wished I'd put more money on my short when it had its final capitulation fall at the end of 2018, all the way down to sort of around about $3,000. It's almost the rule of trading, which is that you will never have enough money on the best trades. You know, the ones that are the most profitable, you will always be going, oh, I wish I'd staked more on that particular one. Yeah, it's funny how it always works out that way. It's probably just in my head, and in other people's heads it's not like a real thing, I suppose, but it always feels that way. So yes, the answer is yes, you can have short positions when prices are falling. And as I say, in recent months, actually, I've made a bit of money. Like here, for example, in September, as that fell, I went short there, made some money, closed the trade at the bottom here before the bounce off that support line. But if you want to know more about shorting and so on, again, I sound like a broken record, but my book, The Crypto Trader, which I better show you a picture of, because there's this code, isn't there? I better stick it up on the screen. Hold on. While I answer the other questions. Can you see that?
Yes.
Yes.
So we've got a question here as well. Do you have any tips for screening for trends?
Hold on. Oh, sod it. Sod the slideshow. It's only one slide that you need to see anyway. So yeah, just have a look. There's your code, crypto40, blah, blah, blah. Right, sorry, what was the next question, Alex?
Do you have any tips for screening for trends?
Oh, I noticed Sam is asking about day trading.
As well, yeah. You can
Okay,
answer that as well, yeah.
I'll do it in order, yeah. So Sam is just saying, what about day trading? I try not to do day trading. When the crypto market's moving really, really fast, sometimes I will get in and out within a single day, just because the market moves so fast. It might go up like 20% in a day from time to time. Bitcoin and other cryptocurrencies do. And so sometimes I will get in and out quite quickly. But as a general rule, day trading is less profitable than other kinds of trading. Again, that's pretty much a statistical fact, partly because of the spreads, because you have to keep buying and selling. It means that you rack up the costs of trading quite quickly. Whereas if you're trading longer term, you know, keeping positions for days, weeks, months even, then your trading costs are incredibly low, because you're hardly opening and closing any trades. And yet if you're following the trends, your profits can keep just going up and up and up and up. So day trading is, in general, generally speaking, less profitable than longer term trading. But I mean, the day trading is really mainly left to the machines these days, the algorithms, you know, large computers with complicated programs at investment banks. They make most of the money doing high frequency day trading. Not many individual people, ordinary people, make money day trading, but you know, I'm not going to say I rule it out. I do it occasionally, I do it sometimes myself, and also some people do make money, the people who specialize in that and are really good at it. So that's my answer on that one. Lara says, do you have any tips for screening for trends? Yes. Now, ATFX, who are hosting this webinar, Alex is from ATFX, of course, they use MT4, don't you? MetaTrader 4, is that right, Alex?
Yeah, that's correct.
Yeah, so there are various tools that you can use on MetaTrader 4, but I will just show you a very quick tool now on TradingView, which is just a free charting platform, you know, where you can just look at charts for free, because it's just one that I happen to know off the top of my head, and that is down here. You can see right at the bottom it says Crypto Screener. Can you see that, Crypto Screener? So you can click on that, and it gives you loads of options, filters for how you can decide how to screen for cryptocurrencies. And in this case, what I'm actually, no, let me find you another one that I've done myself. Here you go, crypto's new monthly high. That's one that I define myself, for example. At the moment, there are no matches at all. But on some days when crypto's having a good day, you will get tons of them. You'll get, you know, dozens or even hundreds of matches. But as you can see, it says no matches at the moment for cryptos that are making a new monthly high. But that's a good way to kind of see what's trending in the right direction, is simply what is higher than it was a month ago. And that kind of gives you a good idea. But here's another one that I've done, a moving average crossover. I defined you can see it says short MA cross. I defined a moving average crossover whereby the price is just crossing above a 20-day moving average. Really, really simple to do. Pretty much the simplest technical analysis you could ever want. And it's got me 350 matches already. So, you know, when I'm screening, Lara, quite often I will use moving averages. Is the price above a short-term moving average? If it is, then you know it's kind of probably heading in the right direction. It's heading upwards, and that will give me an indication. And there are so many filters that you can kind of, you know, you can define all kinds of different ways, new monthly highs, new daily highs, change percentage, you know, what cryptocurrencies have gone up by more than 5% this week, or which ones have gone up by more than 10% this week. And again, that will tell you which ones are starting to trend upwards. It will give you some that you probably hadn't noticed before that are trending upwards. So those are just a few. But Lara, if you want to, well, if anybody watching wants to get in touch with me privately, go to my website, glengoodman.com, go into the comments box, because there it is, glengoodman.com. The what do you call it, the registration, the mailing list thing. I don't really send out a newsletter. I just send out the odd thing saying, look, I'm doing this webinar, for example. But you can contact me and message me through there, and then I'll have your email address, and that way I'll be able to email you backwards and forwards. You can ask me more in-depth stuff about screening and scanning if you like, but I better stop answering that one now because we're getting near the end. Have I got time to answer the last couple of questions if I'm quick, Alex?
Yeah, that should be fine. But let's yeah, give a few more minutes. But then we have Ian. He's joining us.
All right, sorry, Ian. Sorry to take up your time. I'll be really quick with this. Right, 1% means you need to do loads of trades. Too time-consuming. No. Oh, right, you're answering the 1% thing that I mentioned earlier. No, it doesn't mean that you need to do loads of trades, because remember, you're only risking 1% of your portfolio, of your trading account. That doesn't mean the actual size of the trade is 1%. That's an important distinction. You're risking 1%, which means that in the worst case scenario, if it hits your stop loss, which I hope you would have set a stop loss, then you would lose 1% of your total money. So if you have, say, quite a tight stop loss, then you can place quite a big trade, have a tight stop loss at 1% of your trading volume, yet the actual trade itself is quite big. I hope that makes sense. You're just always making sure that wherever you place your stop loss, you never lose more than 1% of your money. So obviously, if you have a very wide stop loss, then the trade is proportionately smaller, if that makes sense. So if you, yeah, okay, I better stop there. Last one, how can you increase odds if you are trading breakouts? Because I feel most of the breakouts fail. This is Jitin. Yes, a lot of breakouts do fail, and it's very frustrating, and that is a big cost of trading. You're saying, how can you increase the odds? You increase the odds by following these patterns that I've talked about, the triangles, the head and shoulders, all the stuff that's in my book. And and indeed lots of books. My book is specifically about trading crypto, and it tells you what exchanges to go to and all of that. But the actual trend following and technical analysis rules are quite general ones that apply to all different markets, and they help you increase the probability of any breakout being a success. If you have, for example, a nice horizontal boundary, your breakout is statistically much more likely to be a success than if you have a really horrible sloping boundary and the resistance line. You see, so it's tricks like that. You're looking out for the high probability trades, like with the horizontal lines, that kind of thing. So, oh, we have more questions, but I'm going to have to stop, aren't I? Alex?
Yes, but why don't you give them the link to your Facebook page so they can ask you questions that way,
Okay.
or whatever is the best way to contact you.
All right, so any of you, as I said, go to glengoodman.com, scroll to the bottom of the page, fill in the little contact me form, and you can ask me any questions you like there, and I will be happy to answer them at my leisure. No, today I will answer them immediately if you ask them immediately. So thanks everybody for joining me. Hope you had a nice time. Good to chat to you all. I can see some familiar faces in the comments, which is nice to see. Hi Chris, hi Karen, hi Laura. See you all then. See you, Alex. Thanks for hosting.
Thank you so much for joining us. Guys, I hope you
Okay.
enjoyed that presentation. We're now gonna move along, and we have Ian that's going to join us.